Hi, I'm Simeon Wallace, Chief Investment Officer of Apri Wealth Management, and welcome back to The Pulse, where we take a month-to-month look at what happened in the economy and the capital markets to make better decisions in your business and with your investments. Let's start with the markets. May was strong, with the NASDAQ and emerging markets leading. For the quarter and year to date, we see the same. The big story is AI is driving returns. The emerging markets returns reflect big South Korean technology companies such as Samsung and SK Hynix, while markets globally are higher. But beyond stocks, every other market is telling a different story. Bonds that are more interest rate sensitive are taking a hit, while high-yield bonds that are more economically sensitive are marginally higher. The reason? Concerns over inflation. Oil is up 84% this year, while commodities such as copper are increasing. We have mostly completed Q1 2026 earnings season, and it was very strong. Among the S&P 500, over 80% of companies beat earnings estimates, 6 times as many as those that missed. Now, earnings grew nearly 30%, more than twice as fast as expected, with many sectors increasing double digits. Just 44 companies tied to AI drove 71% of all earnings growth. The rest of the S&P 500 grew, but at a more measured rate. The labor market supports the earnings growth story. In contrast to what you hear in the headlines, young worker unemployment is declining and has dropped back to pre-pandemic levels. Seeing the growing demand, companies are looking to invest in growth and add to payrolls. With relatively tight labor markets, workers switching jobs are getting real raises. If you're hiring this year, be thoughtful about how you'll attract talent. Another sign of economic growth? New business creation has more than doubled since 2019. AI is making it easier to start a business. Note that this may mean more competition is coming. History shows with technological advancements, lower input costs increase demand. The fear that AI will gut white-collar jobs isn't what the data shows. Cheaper work is creating more demand, not less, often where you least expect it. Workers learning AI will outperform. Now, the economic growth and rising commodity costs that we've discussed have caused markets to flip its view on interest rates. The Fed was expected to cut rates this year. Investors are thinking the opposite, pricing in rate increases looking forward. To sum up everything from today, here are the key takeaways. The economy is healthier than headlines suggest. AI is the engine. Move aggressively to embrace it. It's creating more work, not less, while employment levels are tight. And finally, plan for higher rates with capital expenditures and refinancings. With that, I'm Simeon Wallace, Chief Investment Officer of Apri Wealth Management, and I'll see you next time with our next edition of The Pulse.